If you have questions about the infinite banking concept, whole life insurance, or implementing this idea of becoming your own banker, make sure to put a question in the comment section below or reach out to me directly. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. It's time for another installment in our Q&A series where I address your questions about whole life insurance, the infinite banking concept, your situation. It's a great way for others to speed up their learning curve on this subject by me answering your questions. So feel free to put any questions below in the comments or, of course, reach out to me directly. So question number 1 comes from Rob. Rob asks, does my wife have to sign for a policy loan? Great question. In fact, it is required in certain states, so you should know this for your state. This individual was asking me from Texas, and when it's on the form, there's a section on a form, for example, when you go to make a policy loan, if you're doing it online versus over the phone or whatever that looks like, whichever route you choose. But getting a signature from a spouse in certain states is required. Yes. That is true. Tiffany asks, I have a HELOC. Should I use that with a policy? Great question. Very appropriate. Lots of folks do decide to incorporate infinite banking with whatever it is that they have going on in the real estate world. Should you? I mean, I know that you and I have had a conversation, Tiffany, but again, here for the benefit of everyone else, there is an attraction, of course, to using banking with what people do in real estate. Of course, everything is finance, but I know that people look to real estate as a way of investing to improve cash flows, have appreciating assets, etc., leverage equity, like this particular question about using a HELOC, using a home equity line of credit in conjunction with becoming your own banker. Plenty of people do decide to move equity from a home, let's say, into a policy, and then, of course, from a policy, bank with that capital to be able to repay that loan, do profitable things with the money to grow and expand what it is that you're doing in your private banking system. So to answer the question of should you, I am encouraging people to become their own bankers. And whatever it is that you're already doing with capital, if you are also the banker, if you're controlling the banking function, I think that's great because it does put you in the position of control and then therefore profitability. So you can be controlling and profiting the banking function, and that can include investments that you are making, such as doing things in real estate. So yes, plenty of people do decide to use equity that they have access to from real estate to fund policies, to augment policies, to start new policies, lots of different ways. Everybody's situation is very different. This isn't advice, but that's a great question, and there's a lot of potential there. Daniel has a real simple question, but it's very important. I know it is for everybody. Daniel asks, can I split my death benefit between my children? Yes. When you are putting a beneficiary for your policy, you can put more than one person. You could put more than one entity. You can have a contingent beneficiary. If for whatever reason one person passes that you would have had as a beneficiary, you can have a contingent beneficiary that's worth updating on a regular basis as needed. And hopefully you are having regular consultation calls with whoever your agent or advisor is. If you're one of my clients, of course, I hope that's the case, that we have regular and ongoing conversations about those types of things so that you do have up-to-date beneficiaries or contingent beneficiaries or a trust or whatever the situation is that you want. But the answer is yes, you can split death benefit from your policies. Adrian asks, starts by making a statement. I started looking at infinite banking by seeing IULs and says, I decided against IULs for dividend paying whole life. Great. Thankfully, IULs, I'm interjecting here already and I haven't even got to the question, but thankfully IULs, and universal life was a thing, of course, but thankfully I got to see a live presentation in a room that worked for me, obviously, at the time that I saw a presentation on whole life insurance. And ironically enough, I owned 3 whole life insurance policies when I saw my very first presentation, when I was first exposed to the idea of becoming my own banker and began learning what whole life actually was and could be. I already owned 3 whole life policies from a mutual company. So terribly interesting. And I'm grateful, I guess, is what I wanted to say, that I wasn't exposed to the noise around IUL's Index Universal Life, and I didn't have to compete with that. But it's out there now, of course. And interestingly enough, again, seeing information about IULs where people do purport that you can do infinite banking with IULs. Again, if you'll go to the book that was written by the guy about the idea of becoming your own banker, of infinite banking, he's got a chapter in there where he talks about he doesn't own and didn't write any universal life policies. Any universal life policies, not variable, not equity, not indexed, no universal life. I also personally don't own any universal life policies. Don't write any universal life policies. Wouldn't have them. But let's actually get back to Adrian's question. So the question was, after saying that from seeing things about IUL, it brought him to seeing things about infinite banking. The question is, what is the PUA? Great question. Great question. So there may be a few riders, several riders on a policy, a whole life policy from a mutual company that pays dividends. There may be. And some of those come just naturally attached to the policy, depending on somebody's health rating and other things. They can get a chronic illness rider, terminal illness rider. They may want or need a term rider, and just different things. But the paid up additions rider for sure is a rider that we want on every banking style policy, because it's what allows us to have an early significant cash value on a policy, so that we could use the policy even in its first year for infinite banking. So the paid up additions rider, PUA, paid up additions rider, allows you to pay additional premium. It does buy you more death benefit, not at the same rate that base premium does, meaning premium for the whole life policy itself, the chassis, the skeleton, the framework of an IBC policy, an IBC style policy, is the whole life policy itself. And then the paid up additions rider is added on to the whole life policy. When I was first exposed to infinite banking, it was expressed in this way. Imagine a rocket ship. Imagine a rocket ship. It's got the shuttle. It's got the big boosters attached as well. So those big boosters are like the PUA. They allow the spaceship to break away from the gravity of the Earth, penetrate through the atmosphere, and the further they go, the more efficient, the faster, and everything that system is going, and they eventually reach a point where they would even fall off. Now, we want the ability to be able to pay significant premiums into policies. PUAs allow us to do that more efficiently. Also, the PUA rider allows us to buy additional death benefit. All this is happening at the same time. I hope you understand. And it creates a significant cash value for us in the policy early on. Now, over the lifetime of the policy, it certainly may be that those rocket boosters, if you will, fall off, meaning that you may not be able to continue to pay into the paid up additions rider for the whole life of the policy. We do want to be able to do that for a very long time, as long as possible. But of course, the policy just gets more and more efficient over time. And it's like the space shuttle that can keep going because of the efficiency that's been built up from takeoff. So the paid up additions do everything there, allow us to get more death benefit, allow us to pay a more significant premium. Remember, we're trying to fit as much of our cash flows as is reasonable and possible into this private banking system. And it does create an early cash value. The paid up additions rider does. So great question, Adrian. And thanks for letting me walk through all of that explanation here for everyone. Bree asks, how can I get in info to verify the validity of your business? Well, I would say, and I gave Bree an answer to this already, but again, for everybody, number one, I encourage you to vet, to research, to look into, to consider the concept itself, the idea of infinite banking. Now, how you can vet the idea of becoming your own banker is to go right to the source material. Read the book, Becoming Your Own Banker by R. Nelson Nash. Check out my presentation. I've got an introductory presentation that takes you from A to Z to introduce you to this idea of becoming your own banker. That's on YouTube. That's on the channel. That's on the website. That's free. So educate yourself on the concept, number one, and just vet the concept for yourself. From there, it does matter who you work with. I intentionally and exclusively do infinite banking style policies. That's what I do. I help my clients on their journey of becoming their own banker with IBC style policies. Those are whole life insurance policies from mutual companies that pay dividends. So I'm a licensed agent and I do work all over the country. So whatever state you're from, if you're considering doing business with me, if you would like to be my client, you can go to your Department of Insurance's website and look me up and see if I'm an actual licensed agent. I mean, I'm telling you that I am, but if you want to verify that for yourself, I would encourage you to go check out information. You can look me up by name or anyone else, okay, and just see if they're a licensed agent in your state. Check that legitimacy. So the concept itself, the individual, the agent, the advisor that you're considering working with, of course, you could look into the insurance companies that you're considering or that your agent or that your advisor is considering or showing you policy illustrations from. And what you're going to be what I would suggest that you look for is what Nash says in the book, of course, is that you look at mutual life insurance companies, not stock insurance companies, but mutual life insurance companies, that you verify that they have a track record of paying consecutive dividends, and they have that track record without interruption for at least 100 years. And of course, several of them have been doing it even a lot longer than the past 100 years, but that's a very long time. So they've got a very long track record of paying those death benefits that they're promising in these legally binding contracts to everybody. And not only that, but they've been paying a dividend for all of those years consecutively as well, through all of the global wars and the pandemics and the recessions and the depressions and the dot-com bubbles and the housing crisis and everything else that's taken place. They've been profitable, kept all of their contracts, and even paid dividends. So you could be looking into the company. What's their rating? Are they a well-rated company? And things of that nature. It wouldn't hurt if the agent who is suggesting that you buy a policy from a certain company has a policy from that company. They actually practice what they preach. That would be one good thing. So those are some great ways to be able to vet the legitimacy of anything that you're considering doing in this infinite banking space. Make sure to let me know down in the comment section if that was helpful or if anybody else has any further questions about that. Jay asks, what is the downside to whole life insurance? That's a great question. It looks like there's a follow-up question here in a second. Yep, there's a follow-up question. So Jay's asking two questions. What's the downside to whole life? The internet will give you different examples that it could be perceived as a downside. Now, I'll give you a common one, and I address this at length in my Myths, Mysteries, and Misconceptions playlist, where I address things like, well, whole life insurance is 20 times as expensive as term insurance, like Dave Ramsey says. Okay, so I would encourage you to check that out. Myths, Mysteries, and Misconceptions playlist on the YouTube channel. Check that out there at length. I think it's a pretty good example and explanation of that perception or misperception. So I would say this: if you are considering implementing infinite banking, and that is why you're considering whole life insurance as the ideal asset, the ideal entity to privatize your banking, I would point out a couple things. Number one, I'm aware of 16 characteristics of the ideal asset that I see represented in a properly structured whole life policy with a mutual company that pays dividends. 16 characteristics. Okay. And I've gone into that at length. Furthermore, once you own that appreciating asset, that ideal banking entity, what's the downside? Well, the downside is you. You are the downside. You are the variable that we don't know. Okay. So consider this analogy. If you put me in a brand new, perfectly conditioned and prepared race car and a professional driver in a like or a similar race car, who's going to do better? What's the downside? Well, the downside there is that I am not a professional driver, and I will not perform the way that professional driver does. So the downside in implementing this infinite banking concept is, well, Nash says be an honest banker. I don't know if you're going to be an honest banker. I don't know if you're going to steal the peas like he would say. Okay. So you're the greatest variable. You're the potential downside. Now, you're obviously the potential upside. You could be a great banker. You could decide to think long range, to capitalize your system well, to not do business with banks anymore, be an honest banker with yourself, grow and scale this private banking system, okay? Become very profitable, all these types of things. Also, you have to deal with the human problems that he mentions, like Parkinson's law. We all have to confront the natural human tendency to spend all that we earn. Are you going to confront that? I don't know. So that's the downside, is you and me. The asset is just the asset. It's going to do what it does. A properly structured whole life policy is going to grow and compound, period. It's a unilateral contract. When we pay premiums, that insurance company is guaranteeing a tax-free windfall to our heirs or beneficiaries, whoever it is that we decide is going to be the beneficiary, tax-free windfall. They also guaranteeing the cash value that we can leverage and access via policy loans for the things that we want to do, like account for the banking function in our life. So the downside, it's you and I. And we have to confront those human problems today and every day. Parkinson's law, Willie Sutton's law, the golden rule, the arrival syndrome, and use it or lose it. If those are new to you, again, I'd encourage you to get into the Becoming Your Own Banker book and learn about and confront those 5 human problems so that you can confront the potential downside to this idea of becoming your own banker. And then Jay's second question was, why is only a portion of the premiums available in cash value? Okay, great question. All right, I see what you're saying there. I see what the question is there. All right, so when you're just starting a brand new policy, and whatever the premium amount is that you've chosen and you've paid that, in this brand new policy, year one, you don't have access to the same amount of cash value as you've paid in premium. Okay, there's a capitalization phase to a whole life insurance policy. So I would say look at starting a whole life insurance policy as starting a new business. And Nash talks about this in the book. He uses a grocery store as an example. So just imagine that you take some money to start a business. And even in that very first year, that business creates a cash flow, an amount of capital that is at least half of what you paid. That is a great business in its first year. If a business is producing half of what went into it to get it started in its first year, that's a fantastic business. And if by contract you knew that that business year over year guaranteed would improve and increase and even get to the point where it was obviously and hopefully, but with a contract, with a policy, it's going to be by contract, it will produce more capital than you've even funded the business with. Well, that's exactly what a whole life insurance policy does. Yes, there is a loss of liquidity when a brand new policy is getting started, but there is not or ever a loss of value. Remember, all the premium dollars that you pay grow and compound uninterrupted for your whole life, and they create that cash value that for your whole life, again, it grows. It increases. On weekends, on holidays, that cash value increases. It's not equal 100% to the premiums in year one. And if it's built correctly, it won't be in year 2, won't be in year 3. There will be a time frame. Nash says in his book, 4 years, at least 4 years. At least 4 years. And the further out that is, the better it can be. Everybody's situation is different. I don't have a cookie cutter approach to this, but what I'm saying is that while there's a loss of liquidity, there is not and never a loss of value. And if you walk this out, this idea of having this policy for your whole life, there will be a pool of capital created that you can leverage that will be greater than the premiums that you've put into it. And I think that considering it like a business is a great way to consider it. You let me know in the comment section if that is helpful to you. Thinking of starting a whole life policy as a business. But let me also say that I am specifically comparing a whole life policy to a business and not an investment, because whole life insurance is not an investment. That is a theme that I've also covered on my Myths, Mysteries, and Misconceptions playlist. So if you've heard that, make sure to check out the episode there. So again, I hope that this has been helpful for you. If you have a question that you'd like to put in the comments section below, if you put that there, I will read it. I will respond to that. Otherwise, if you'd like more information about how to implement the infinite banking concept into your household or your business or your investing, contact me at my website. I've got my free presentation there, and I've got my calendar link where you can book a free consultation call with me where we can talk through what it looks like for you to implement infinite banking into your household or into your business or into your investing. This has been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care.